Here, we'll look at some of the common financial errors that frequently result in severe financial issues. Even if you are currently in financial trouble, avoiding these blunders could be the difference between life and death. Before starting, don't forget to like and subscribe to our channel for more future updates. So let's start. Number 1. Excessive and frivolous spending. Large quantities of money can occasionally be lost $1 at a time. When you order that pay-per-view movie, go out to dinner, or buy that double mocha coffee, it might not seem like a huge issue, but it all adds up. The $1,300 you would save by eating out only once a week at the 25th of may be used to settle several other credit card, auto, or other debts. Avoiding this error is crucial if you are experiencing financial troubles because, if you are just a few dollars away from foreclosure or bankruptcy, every penny will matter more than it did before. Number 2. Never-ending payments. Do you really need the items for which you pay monthly payments for an entire year? Cable television, music services, and pricey gym memberships are a few examples of things that could force you to continually spend money while providing little in return. Living a leaner lifestyle might be beneficial when money is tight or you simply want to save more. By doing this, you will be protected from facing financial difficulties. Number 3. Living on borrowed money. Credit card payments for necessities are now accepted almost everywhere, even while more and more people are willing to do so. Paying double-digit interest rates on food, gas, and a variety of other products that are consumed before the bill is fully paid is not a prudent financial decision. The cost of the things charged on credit cards is significantly increased by credit card interest rates. When you utilize credit, you could occasionally spend more than you make. Number 4. Buying a new car. Even though only a small percentage of buyers can afford to pay in cash, millions of new cars are sold every year. On the other side, if you are unable to pay cash for a new car, you might not be able to get one. Having enough money to pay the bill is not the same as having enough money to buy a car, after all. The gap between the worth of the car and the amount paid for it is also widened by financing the purchase and paying interest on a depreciating asset. Even worse, many individuals experience financial losses each time they trade in their cars, which occurs every 2 to 3 years. Consider getting a car that uses less gas, has lower insurance costs, and requires less maintenance. If you need to buy one or borrow money to do so. Because cars are costly, buying more than you need can mean losing money that could be used for savings or debt repayment. Number 5. Rushing to buy a home. Buying your own house is one of the most significant financial decisions you will ever make. But it's important to know how much you can afford to spend on your house. Because a home loan is one of the biggest commitments you may ever make. You should decide to invest in a property when you have sufficient funds and can comfortably make your monthly home loan payments. If you don't have a home loan, you won't be as stressed up and won't have to take as much money out of your paycheck each month for EMIs. Number 6. Failing to save for emergencies. Almost 60% of Americans don't have enough money in savings to meet a $1,000 unforeseen emergency, such an unplanned auto repair or a high hospital cost. Millions of people run the risk of having their financial circumstances ruined by even a small tragedy if they don't have a safety net. Typically, it's advisable to save up 3 to 6 months' worth of costs for your family. As a general rule, you should set aside 10% of your net income. If you find that amount to be insurmountable due to your monthly expenses, try starting with 5% and increasing it by 1% each month until you reach 10%. Number 7. Living paycheck to paycheck. The U.S. household personal savings rate was 9.4% as of June 2021. 2 unexpected problems can quickly turn into catastrophes if you are unprepared because many families may be living paycheck to paycheck. People regularly find themselves in precarious circumstances where they must maximize every dollar of income, and where one missed payment would have catastrophic consequences given their entire expenses. You don't want to be in this situation during a downturn in the economy. If this occurs, your options will be limited. 3 months' worth of spending should be kept in an account that is easy to access, according to several financial experts. Your money could run out due to a job loss or other economic situations, which would keep you trapped in a debt repayment cycle. A 3-month buffer can make the difference between keeping your home and losing it. Number 8. Not investing in retirement. You might never be able to retire if you don't use your money to invest in the markets or other assets that generate income. For a pleasant retirement, Consistent monthly contributions to specified retirement funds are necessary. Use your tax-deferred retirement assets or a retirement plan that is provided by your company. Determine the level of risk you are willing to take and the time frame for asset growth. To match this with your goals, if at all possible, seek the advice of a skilled financial advisor. Number 9. Paying off debt with savings. If your debt consumes 19% of your income but your retirement account yields 7%, you might believe that exchanging the retirement account for the debt will allow you to keep the difference in your pocket. But it's not quite that easy. It is quite difficult to repay your retirement funds. And you face the danger of paying exorbitant costs on top of losing the benefit of compounding. Borrowing from your retirement account may be a possibility if you go about it the proper way. But even the most fastidious planners find it challenging to place money aside to replenish these assets. The pressure to pay back the debt typically subsides when it has been settled. It will be quite tempting to keep up the same level of spending, which raises your risk of piling on more debt. You must continue to live as if you still owe money to your retirement account even though you desire to pay off debt with savings. Number 10. Overusing credit cards. One of the most common financial hazards is amassing credit card debt, especially for those who are just entering adulthood. A large credit limit could tempt you to spend more than you can afford. Even while a credit card can be a useful tool for building your credit history, it is frequently forgotten that the minimum payment usually only covers interest. While many Americans are in debt due to vehicle or student loans, increasing credit card debt is a much bigger concern. Many benefits can come from using credit cards responsibly, but you should make an effort to avoid getting into debt. Even if you already owe a lot on your credit cards, you can still manage to pay it off. Consider using a personal loan or a credit card with a low balance transfer interest rate to pay off those balances. Then, to improve your credit score, decide on a card to use for regular purchases that has a solid rewards program and a reasonable interest rate. Number 11. Not asking for a raise. Usually, you have to work very hard and make sure you tell your employer that you want a raise. The company might only give you a paltry 5-7% raise per year. Yet, you'll need to let your manager know if you desire a significant increase. If you believe that your skills and qualifications are not being recognized appropriately at your current place of employment, don't be hesitant to look into alternative employment alternatives. Remember that if you change jobs, you have the ability to negotiate for a higher salary. Taking a step back is necessary in order to recognize the financial mistakes that have been done. You can avoid accruing a significant amount of debt by keeping an eye on your modest expenses. Remember that it is better to save up for a significant purchase than to rely only on your wage to pay off your debts and to think twice before adding any more mortgages to your list of regular obligations. If you recognize some of the mistakes you've been making from the list above, develop a plan to avoid them in the future and make better financial decisions. Number 12. Not buying enough insurance coverage. Having the appropriate insurance, such as medical, vehicle, home, long-term care, life, and disability coverage, is necessary for sound financial planning. It can be difficult to decide what kinds of insurance and how much protection you might need. But failing to have the right combination of insurance might be catastrophic if you have an unexpected expense. It's a good idea to review your insurance coverage each year and determine which policies you might or might not need in light of any big life events. For instance, if you've recently purchased a newer, more expensive vehicle, it's crucial to examine your auto insurance. If you recently got married or had a child, it might be time to examine your health insurance. If you've recently completed a big, value-adding home renovation, it's generally a good idea to increase your homeowner's insurance. You must make sure that the insurance you have purchased will completely cover the value of your rising assets. This is it for today's video. What do you think of our video? Tell us in the comment section below. Don't forget to like and subscribe our channel. Thanks for watching.